Let me welcome our first speaker, Avi Goldfarb.
So you know where all this is coming from. Ajay Agrawal, Christian Catalini, who's now at MIT, and I started thinking about crowdfunding when we first heard about Celiband in early 2007. Okay, and everyone said, "Hey, what are you guys doing? What's this thing? It's this crazy fad, some Amsterdam-based tiny little company that was maybe the grandfather of crowdfunding, if any." And so we started thinking about, well, what's interesting? How does this mechanism work? How might it work? A few years later, Kickstarter appeared, and everything started to really take off. And so, having thought about this now for a few years, what I want to talk about for the next 15 minutes or so is just some simple economics of crowdfunding. How do we think about crowdfunding? Who are the players? What might go wrong? And what are the possible solutions? Okay. So, just to give you a sense of the economic structure, there's three types of players. There's entrepreneurs or creators, depending on what platform you're on. They have different labels, but I'm going to call them entrepreneurs. There's funders, people who provide the money. And then there's the platforms who want to exist in the middle between those entrepreneurs and those funders. Okay. And each of them have different incentives to use crowdfunding. So why do entrepreneurs use crowdfunding? Well, they get money, presumably for a lower cost than they get money from other places. That's why entrepreneurs and creators use crowdfunding. Whether it's equity-based or non-equity-based, the idea is they're getting funding at a lower cost than they otherwise could. They also get some information about whether their idea is any good, and that can be useful too. Okay. So let's think about, what do they get? Why do they have a lower cost of capital? Well, first, it's a global search. Right? You have venture capitalists in Silicon Valley, you have a whole bunch of angel investors in Silicon Valley, a few elsewhere, and you have a whole bunch of tech startups in Silicon Valley. That's a pretty narrow market. Okay? The promise of crowdfunding, especially the early big promise of crowdfunding, was this idea that you could get money from anywhere in the world. And in Celiband, our sort of first crowdfunding platform, the average distance between, this was a musician, but we'll call them entrepreneurs, and funders, was about 3,000 miles. Okay. So this is not co-located funders and entrepreneurs overall. They're huge distance. And that means you can draw from a global market. Maybe you'll get people who are more excited about what you're doing, and they'll pay you, they'll be willing to accept a little bit lower return on their capital. There's another part which we call bundling. What do I mean by bundling? Well, when you put money into a crowdfunding campaign, you get stuff other than the direct return. Okay? Yes, maybe you get a t-shirt, maybe you get equity and a return on that equity, maybe you get something to resell, but you also get the feeling of supporting something early on. And so one of the things entrepreneurs are selling, creators are selling, is that good feeling to the funders. And because those funders get that good feeling, they're again willing to accept a little bit lower return on their capital than they would if they were investing in a traditional investment. Now, not only that recognition, that good feeling, they get early access, they like early access, and you also get to participate. You get to communicate with the creator, with the entrepreneur. And again, people are willing to pay for that. And music in particular, if you look at the data, people like talking to the musicians. Okay? They like being able to send the musician an email and have that musician respond, especially if that musician happens to be young and good looking and all these sorts of things. Right? That's a big part of what was happening on Celiband. People wanted to communicate with the artists, and they were willing to pay for that, essentially by accepting a lower return on their capital. Okay. And so whether it's equity or non-equity or some kind of hybrid, part of why there's a lower, part of why crowdfunding is appealing to entrepreneurs is because they don't have to pay as much for their capital. The last piece for a lower cost of capital happens after the crowdfunding piece. So crowdfunding actually can get you recognition. You can say, hey, there's an audience, there's a market for this product. If you think about Pebble, or if you think about Oculus, crowdfunding told the venture capitalists, you should look at this. And then follow-on money jumped on. Now, there's a little bit of a risk here. It's not obvious you need crowdfunding in a platform relative to simple pre-sales. Ophthalmic just used pre-sales for their Myo armband, which sort of moved in parallel to other wearable computing devices. But one thing that crowdfunding does is it provides information to follow-on funders to reduce the cost of capital after the campaign. Okay? That information is also useful to the entrepreneurs because they get to know, stuff about market demand. What do funders get? Funders get these investment opportunities and they get to feel good and they get to support things early on. Described all the things that funders get are the things that lower the cost of capital to the entrepreneurs. What do platforms get? Platforms, one last thing on funders. So one thing that funders get is you get the reassurance that your cousin's not going to steal your money. Okay? So a big part of these early on, this came up in the conversation, a big part of what happens early on in crowdfunding is that it's friends and family who put that early money in. And it used to be your cousin went to you and said, hey, I'm making a movie. Give me $100. And if I can, I'll get enough money and I'll make a movie. You'd say, there's no way. Now what happens, you have a reassurance that there have to be enough people, your cousin has to have enough money to make the movie because of that provision point mechanism that we talked about, that threshold that you have to pass. Okay? So that formalization of the contract with your friends and family make crowdfunding very appealing to that kind of funder. Okay. And platforms get, sort of obvious what platforms get. That's their business model. Okay. Now, what might go wrong? Okay. 3 broad things. There's risk, there's incompetence, and there's outright fraud. Okay. Risk, early stage projects, whether they're in the arts or technology or anything else, are risky. By definition, we don't know if the idea is any good. And so the success rate is going to be very low even after funding. Okay. And so not for any fault of the entrepreneur or anything else, but low success rate, that's risky. That is one thing that can go wrong. The project, we should expect most projects, especially in tech, not to work. And for the average institution, the average investor on the street, that might be a little frightening. Entrepreneur's idea is actually, on the entrepreneur side, there's risk as well. You post your idea, someone else might steal it. Okay. There's incompetence. Well, you might have a great idea, but if you haven't backed somebody who knows what they're doing, their great idea might fall apart. Okay? And then finally, there is outright fraud. We heard about this. Kickstarter does what they can, Indiegogo does what they can, but there is outright fraud. This is an open platform. It is hard to police it completely, and that is a big risk. The entrepreneurs might have no intention of delivering the product. And there's lots of examples of them just posting other people's products on a crowdfunding platform and say, hey, this is my product. I'm going to sell it, I'm going to build it and sell it, and just so pure fraud. So all of these are driven by what's called information asymmetry. All of these are driven by the funder and the entrepreneur know different things. Or in particular, the entrepreneur knows more than the funder. Okay? What can investors do, and what do they usually do? They usually do due diligence, right? You do a whole bunch of research to figure out if this investment is a good idea. That's how traditional investing works. The problem is you never really have the opportunity to meet, usually, between funder and entrepreneur. And going digitally is hard. Furthermore, you're only investing $25 or $50. How much due diligence is that really worth? Okay? Yes, a whole bunch of $50 investments can add up to a lot of money, but for any individual investor, any individual funder, you're only putting in $50. I'm not going to spend 3 days making sure this is going to pay off. It's just not worth it. Okay? And so that means low quality projects come a little hard to detect, and even outright fraud becomes hard to figure out. And then once you've invested, you got to monitor. You got to make sure they're doing what they're supposed to. That's hard if you're not in the same place. And then there's this, again, risk to entrepreneurs. Well, we got to disclose the idea, okay? And someone might steal it. So how does this manifest itself And how does the crowd so far police it? Well, one story that we heard is this, you need to get to 20%. Once you get to 20%, you're likely to get to 100%, right? We just heard that. Well, that's wonderful if we trust the 20%, okay? But if we don't trust the 20%, there's some strange market incentives, okay? So crowds are subject to herding behavior. That's the academic literature on crowdfunding. The one thing we know is that there's herding. Once someone starts to get some funding, it just snowballs. Now that sounds good if the early investors did their due diligence, but if it's just your buddies, if it's just your friends and family, I'm hearing different signals from you too. Sorry, 5, okay. But if it's just your buddies, then you can see all sorts of opportunities for fraud there, or for not doing the due diligence that people should be doing. Okay. So what can we do about this? This is what platforms are for. This is the experiment we're observing. We're seeing lots and lots of platforms appear with different tweaks on the business model. And those different tweaks are trying to figure out what are the right solutions to the problems of asymmetric information. Okay. Broadly speaking, so far 4 have dominated. That doesn't mean these are going to be the best 4. In the long run, we might have a whole bunch of other solutions and a platform that's not yet in this room that ends up dominating. It's too early to really tell. So the first thing that we've seen is reputation signaling, right? You can enforce real identities. You can, if you're an entrepreneur or a creator, you can have a signal like, hey, I have a patent on this, okay? You can create feedback systems like eBay did to make their platform work. You can use trustworthy intermediaries. To some extent, that's what AngelList is doing now, right? Where you have a lead investor who says, look, this is a good project. Second, you can have rules. Okay? So you need to have a business plan. You need to say what your risks are. You can only invest up to so many dollars. These rules mitigate some of these risks. Okay. And you can audit, and in equity, you can do accredited investors only. There's crowd due diligence, which is part of the whole, which is sort of essential to the whole business model as long as we think we can trust the crowd. With enough eyeballs, you know, the story, all bugs are shallow. The herd behavior means there's been limited success in this, but crowd due diligence combined with reputation and rules and regulations has been reasonably successful, as we've seen. Kickstarter, Indiegogo, and others have really taken off. And finally, you just heard the value of this provision point mechanism, that you only get the funds if you have enough money to do what you say you're going to do. This is a new solution to an old public goods problem, and it's been fundamental to allowing crowdfunding to take off. This is by no means the full list. This is what we've seen so far. The challenges are pretty clear. The challenges have to do with asymmetric information. The solutions are still wide open. And so moving forward, the companies that are able to solve these problems are going to be the ones that succeed. Thank you for listening.